All right. Good morning, and welcome everybody to the newest edition of the Real Perspectives podcast. I'm your host, Vladimir Bosanac, the co-founder and publisher of the Registry, and I'm joined today by Tom Fischer. Tom.
Morning, Vlad. Tom Fischer with JB Madison. Happy to be your co-host today.
Wonderful. Yeah. So in this kind of new iteration of the podcast, what we're doing is bringing people from the industry that can really enlighten us and talk about some of the most interesting things that are going on. And one of the great pleasures I have today is to bring Tom to this conversation and have a discussion about some of the interesting things happening in the multifamily space, but also other sort of commercial real estate stories. But certainly that will probably be the heaviest kind of portion of our conversation. Before we do get started, Tom, where do we find you? Where are you?
Well, I'm based in, our company's based in San Mateo, California, and I live in San Francisco, a longtime San Francisco resident since 1999. And my career spanned roughly 25 plus years in commercial real estate, primarily focused on acquisitions, asset management, have done multiple product types, office, R&D, multifamily, worked for real estate operators, for real estate allocators. One of my stops in the past was at UC, the chief investment officer, private real estate role, and now I'm a principal and director of capital markets at JB Madison. Yeah. Our organization runs approximately 3,000 multifamily apartment units in West Coast markets on behalf of 700 plus or minus high net worth investors.
Wonderful. And now that you live in San Francisco, or have been living in San Francisco, Tom, I'm sure the news of the sort of median home price in San Francisco crossing the $2 million mark, has at least a little bit of an impact on the valuation of your home, I expect. Certainly the city has been in the news with all of the AI growth. And are you noticing kind of the vibe shift over the last 18, 24 months?
Yeah, certainly living in San Francisco, trajectory is positive. New mayor, or not so new anymore, Mayor Laurie has, I believe, made positive impacts. Always room for improvement, and certainly the trend is upwards. Yes, it's great to understand that we have all this baked in equity on our home. We bought our starter home 26 years ago now, and I suspect my joke my wife and I have is we walked in like this and they'll take us out like this. It's nice Wonderful. To know that equity's there, but whether we realize it anytime soon or not remains to be seen.
Right. Well, at least you're a paper baron, I suppose. Paper real estate baron.
Real estate rich, cash poor. That's not uncommon amongst real estate operators.
Exactly. Yeah. Wonderful. Well, Tom, part of our conversation here is to, both you and I pick a couple of interesting sort of stories and topics from the commercial real estate world. We're going to, like I said, mainly focus on some of the multifamily conversations, but certainly we'll touch up on some of the office stuff as well. But let's kick it off. Let's kind of talk a little bit, the multifamily rent growth that you wanted to bring up and kind of how that's playing itself out here. And now we're in the second quarter of 2026.
Yeah, certainly during COVID, coming out of COVID with all the liquidity that was sloshing around in the marketplace and people moving to secondary or tertiary locations because of their ability to work remotely led to really strong rent growth. So in 21 and 22, in some markets, we were seeing double-digit rent growth.
Right.
Certainly that has moderated and in fact almost flat in some markets. And I believe that Yardi Matrix, which is a publisher of data in the US, recently came out with, I think, March year over year rent growth across the country was 0.7%. So obviously things have moderated quite dramatically. I think a couple of factors play into that, and then I can convey what we've experienced in the markets that we invest in. So certainly job growth is moderated, household formation is moderated, and there was tremendous supply that was delivered over the last 4 or 5 years in a lot of markets. I want to say, for example, like in the city of Austin, that their multifamily supply increased like 40% or something.
Wow.
Just astronomical. Some of the markets that we invested in, we saw inventory grow by 50% over the last 4 or 5 years. So to revisit our situation again, we currently own in major West Coast markets, so the Seattle MSA, Portland MSA, Bay Area, Sacramento, and Southern California. We also made our first foray into Utah in 24.
Okay.
So we own in that market.
Yeah.
From my own personal or selfish perspective, we'd love to own in Denver, and I suspect we'll add Phoenix as a market for ours down the road. But going back to our experience, what we've seen, I would say, over the last 6 to 9 months is, on average, again, this is a portfolio-wide, some properties are doing better, some are worse, but what we saw over the last 9 months is slightly positive trade out on renewals, meaning that residents that were in our properties decided to renew. We got maybe on average 1.5% rent growth. Other side, for landing new residents, it more often than not required buying occupancy, meaning we offered them concessions to move in. So that then led to negative trade out relative to the prior resident. So all in all, our experience in the vast majority of our markets really matches what's been going on across the U.S.
Now, part of it, and pardon me for jumping in, but part of that kind of whole COVID shift was that there was a big move out of cities or out of markets like the Bay Area, right, into smaller sub markets. Similarly, we saw same with Seattle, people moving to Idaho, for instance, or Montana or someplace like that. I think some of the southern markets benefited quite a bit. I don't know, we don't have to call all the states out, but I expect states like Tennessee, North Carolina, Georgia, places like that. Are those the markets now where we're seeing some of this growth, this average growth is kind of being pulled down by what's happening there specifically? Because I think even though the national rent growth was maybe you said 0.7%, San Francisco is like the highest in the country at like 9% or so, right? Mm-hmm. So are people going back to where they came from, kind of deal, or something else happening?
I think the overall response to that is yes, people are returning to urban cores on average. I think statistics are a funny thing, and market rent growth you can slice and dice the numbers. I think one of the fascinating things or interesting things to point out about San Francisco rent growth is that, yes, rent growth has been gangbusters the last 18 months, 2 years, but they just got back to pre-COVID numbers like 12 months ago. So you got to think about it in the relative context as well as the overall growth context. I would say that in our portfolio, our locations are often in primary markets, but perhaps how people might think of secondary locations. And we saw, for example, we own a property in the Santa Barbara area, like the extreme west coast, or excuse me, the extreme west end of the LA basin. We also own property in the Inland Empire. So those kind of outlying markets, when people were leaving the urban core of LA, we saw explosive rent growth. And now that has definitely tailed off. I think a lot of people who move for remote work, if they are highly educated, highly compensated, they can keep doing that. But by and large, I think the power dynamic has definitely moved back to the employers. I think you see that over and over in headlines with people saying you need to be in the office 5 days a week or 3 days a week and whatnot.
Sure.
I would say we personally didn't chase that movement. We benefited from it in some of our properties, but we also recognize that long-term being in those markets and or chasing yield and while we're long-term holders and focused on stable and growing cash flow yield, that you want to be careful about markets going to where that fall off the institutional or even private capital side, because if you do have to sell in a place like Bend, Oregon, for example, which had awesome rent growth during COVID, there might not always be buyers for that property. So we didn't really chase that. And I would also say we were disciplined in the context of people, not to get too deep in the weeds, but people were going, paying for cap rates in the 3% because they had 2.5% debt. And a lot of those stories aren't working out well.
Right. Are people staying longer in apartments these days?
I think that our renewal percentage, good question. I think our renewal retention rate has been fairly steady. Part of that is strategy. I would say that we are on average, I don't know that it's changed dramatically. I think you still have people a lot of our apartments are expensive. They're the interim stop for people who are buying homes. So we're still seeing that. I think that there's a decent amount of corporate relocations and whatnot, but overall it's been, I think historically we've renewed somewhere between 55 and 60% of our residents. And I don't know that we materially changed from that in the last year.
Yeah, interesting. And I'm also asking that question because interest rates have been impacting the home buying market. Obviously, it seems like it's going to be a slow year in 2026, based on some of the numbers that we're seeing, and just anecdotal evidence as well. So that's why I'm kind of curious if you're already beginning to see any elements of that kind of playing themselves out in the multifamily space. Wouldn't surprise me, but
Yeah, certainly up until recent activities in the Middle East. 30-year mortgages were getting closer to 6% than to 7%. That's starting to shake loose a little bit. I think that's stalled out a bit. Again, I think that when we look at a decent number of our properties, these are people who have the wherewithal to pay $3,000, $4,000 a month for rent. And it might be a way station for them while they look for a home to buy and or remodeling a home and come to our properties for a year while they do that. But I don't know that it's been a huge factor of people leaving our properties, or it hasn't increased in its order of magnitude from what we normally experienced. Other than on the margin, again, you are seeing more people have the ability to afford homes. And yes, interest rates are down, but the other part always people struggle with is where the down payment comes from.
Yeah. And interest rates have impacted the multifamily market quite a bit as well. So I'm curious, what you guys are seeing, and not just throughout your, portfolio, but just in general, across the country. Has that come back to the multifamily space? I imagine so, but I know there was a point in time when it was very difficult to, refinance. And so I'm kind of curious, where the trends are pointing there.
Sure. I think the debt markets right now for multifamily are extremely strong, extremely liquid. There's lots of players. I would say multifamily, along with industrial, has been most people's darlings since COVID. And during the interest rate reset, a lot of banks retreated from the multifamily space. I think they've largely righted their balance sheets, have re-entered the markets. I would tell you that based on my experience on multifamily financing, that spreads are probably as historically tight as they've ever been. But the issue that you're having is where the indices are. So with the sell-off in treasuries, again, given what's going on in the Middle East right now, that has caused a lot of people to pause and or be less aggressive on their acquisition and or underwriting. I think that having said all that, the liquidity in the debt market is still really strong, whether you're going to use an agency, a Freddie Mac or Fannie Mae. Life insurance companies are extremely aggressive. The debt funds are getting back into the business because the short end of the curve, they're priced off of floating. So that is all becoming more active. I think my last closing comment, at least, and this relates to how we think about it, is we would love to do longer term debt, but because of the shape of the yield curve and or the ultimate coupon you get for 7 or 10 year, a lot of people are using 5-year money to make their acquisitions.
Interesting. Well, one of the things I wanted to bring up in our kind of overview of the stories is the unemployment numbers. So last Friday, and to kind of timestamp this, conversation, we're basically in the second week of April, recording this. So there was a March unemployment number that came out relatively positive. I think somewhere in the 78-ish, 175,000 people with job growth. What was kind of hidden behind some of those numbers is that in that final month of March, when the report was done, is that about 400,000 people left the job market. The reason it looked positive is because some of the people were taken out of the numbers, right? And that is a little bit of a concerning trend, I think. There are certainly indications that the economy is still plugging along, but when I see some figures like this, it does make me wonder if things are kind of beginning to turn in the not so good way. On top of that, I've also seen some employment numbers come from the state of California. I'm in California. I'm also in the Bay Area. So the EDD released also some figures last week. They're from January. And unemployment trends, at least from January figures, seem to be doing okay. We happen to, have most of the counties in the state of California that are doing relatively well in terms of unemployment. Santa Clara County, I believe, is number 2 in the state in terms of the lowest unemployment. Orange County comes as number one. But I think like San Mateo and San Francisco are doing relatively well. I think they're below kind of the state average, and they're certainly beating some of the other counties across the state. Tom, tell me how much are you guys following this? Are you worried about these numbers? Are you kind of hoping that this turns? Do you think it's tied to kind of some of the macroeconomic and kind of global affairs sort of things? Where do you stand with this?
Yeah, I think a couple of thoughts on that, Vlad, is that it makes sense in the context of what we saw in rent growth. When we think about employment growth and what drives successful investing for us in multifamily is you need household formation. Job growth leads to household formation, which leads to more renters, which leads to rent growth. As you had mentioned, there's several California counties, especially infill Bay Area ones, that are doing extremely well, certainly better than the California average unemployment and in line with the nation, or perhaps better than the nation. So, personally speaking, when we look at, for example, our properties that we see in Marin County or Sonoma County, great employment numbers, unemployment's very low, but we're just still not seeing a lot of net job growth or household formation, which leads to that flat rent.
Right.
I think in the context of how we think about that, how it impacts our business, is that we're not banking on big rent growth over the next year or two because of that. At the same time, our strategy is really focused on delivering a cash flow yield to our investors the day we close, so we're less sensitive to that. I think a lot of people in the multifamily space that were making aggressive buys in the Bay Area or Seattle or Southern California were banking on extensive rent growth to justify their business plans. Whether that happens or not remains to be seen. I think about some of the numbers when we were prepping for our call. We talked about the EDD numbers in the areas of where the job growth is happening. And certainly we like seeing job growth in healthcare or social assistance, because those are the type of, especially healthcare, when we think about nurses, EMTs, MRI operators, et cetera, they make good income, well-trained, and are good residents. And that gray market, if you will, between white collar and blue collar is oftentimes our strong resident profile for some of our properties. So long-winded way of saying we're still concerned on a macro basis. Are we going to see job growth lead to household formation that allows us to drive rent growth and therefore deliver better cash flow to our investors? We're cautious about that. And it goes back to rent growth. We're very focused on keeping our properties full to put ourselves in a position to hopefully increase our rents when demand does come back.
So Tom, tying back to your first conversation point and to what I was trying to bring up with the jobs and unemployment, are you seeing inflows and sort of migrations of kind of folks from into the areas where you are present? I mean, you're active in sort of areas that are economically doing well, diverse economies, and all that kind of fun stuff. Does that have an impact also on people coming back to those markets?
Yeah, I would say that it's probably even in the context of people that we see leave locations. So we often dive deep onto the reasons why our residents move out of our communities. So we ask them for that. They often are willing to tell us, and job relocations or leaving for other job opportunities is largely balanced out, I would say, on average, with people who are returning or coming back to the Bay Area for those same reasons. And it's not, because it's balanced, we're a little bit concerned long term, but certainly the hope is that it reflects, the trend becomes, let's move back to the Bay Area because we are seeing job growth and household formation that results.
What
from
are you
that.
seeing instead of the Portland MSA, where we're also active, and same with Seattle?
So, Portland MSA, I would say, is really the tale of two markets. So suburban Portland's doing extremely well. Multnomah County and the city of Portland are not, on average, from a multifamily. So we own in Clark County on the Washington side of the state. Our most recent acquisition was in Vancouver, and we've seen tremendous job growth from and net absorption in that market. And it's largely taking people out of Portland that are moving to the other side of the river for a number of reasons. No state income tax.
Yeah, I was going to say, what are some of the drivers there?
No state income tax, quality of life, better schools, less of a street scene issue, all the noise you see in Portland. Don't get me wrong, I love Portland. I love visiting. It's a market that we'd love to own in. We've historically owned in the city of Portland. It's just that all things being equal, Multnomah County is not as business friendly or landlord friendly as you're seeing in Clark County. So I think that that is a dynamic that we're seeing. Having said that, we've looked at opportunities and chased them pretty hard in suburban, whether they're in locations like Milwaukee, Oregon, or Gresham, or Hillsborough, kind of all the major suburban areas that circle the city. Again, we'd love to own in Portland, but haven't been able to make sense of the economics. On the Seattle side, I would say we're seeing, it's kind of a push and pull. We own on the east side, we own in the city of Seattle. And I think that it's kind of been back and forth. Certainly, you are seeing more people move to the urban core in Seattle because companies like Amazon, et cetera, are saying you need to be in the office 5 days a week. That's part of it. And I also think that that city has done a pretty good job of revitalizing the downtown, improving the street scene. So you are seeing a revitalization of downtown. These are urban dynamic experience, dynamic urban locations, lots of culture to offer. So eventually that will be a draw for residents. It's just a question of, will it be enough to justify some of the bets that people made on their rent growth?
Yeah, exactly. Well, hopefully the NBA's expansion team will add to some of that vitality of the Seattle, which would be great. So I have another kind of topic that's kind of related to multifamily, since I have you here as a co-host. I know we wanted to talk a little bit about some of the commercial valuations too, but before we jump there, AI has been on the minds of a lot of people, and if you kind of track some of the folks that I'm connected to on LinkedIn and elsewhere, they often showcase how they're using AI for different sort of ways to be more efficient, cut costs, or whatever in the commercial real estate space. I'm curious, what are you seeing? Is your firm doing something? How active does it make sense to be with sort of these tools today?
Yeah, great question. Certainly a hot topic. I feel like whenever I hang out with people or we get together, my wife and I get together with dinner with folks, we always like, so how is AI impacting your business? How are you utilizing it? Are you finding efficiencies for it?
Are you showing which models you're
exactly
comparing models and stuff?
Are you
on
a
your
Claude
phones?
or a Chat GPT or all the different iterations that are out there? I would say, first of all, our organization specifically, we're already a lean organization. We have 3 senior partners who are really out of the day-to-day and 9 full-time employees, and we manage a $1.1 billion gross asset portfolio. So we're already really efficient. Having said that, we're exploring ways to become more efficient, using AI to do more of the tedious tasks that are repetitious in our business, whether they occur monthly or quarterly. And we'd love to find ways to leverage that. I think from a more global perspective, when we think about the business that we're in and where we've been successful, it really has been driven around relationships that we have. So, and that means relationships with the investment sales brokers that are buying and selling properties, with other owners in the marketplace for sometimes when we go off market, mortgage brokers who are doing our debt for us, and even lenders and the end users and our investors. So much of that is relationship, word of mouth, references, et cetera. So that is still a critical part of our business. I don't know in my lifetime or the remaining time of my career whether that's going to change. I don't doubt AI is going to have an impact on it. But again, when we think about how we've been historically been successful, how we think we'll be successful in the future is to focus on those relationships. Can AI make us more efficient in that? No doubt. We just need to figure out how to make that happen.
Yeah. Exactly. Well, it's certainly interesting to kind of see some of the creative ways that people have been using it, and I'm always kind of curious how it's beginning to permeate throughout the industry. And I do think in the last maybe cycle, there was a lot of sort of tech. I mean, I feel like every company became a tech company. I'm not sure in commercial real estate anybody became a tech company. To be perfectly honest.
Yeah, I mean, we still have residential mortgage brokers, and that was supposedly getting disrupted for sure.
Right.
I think that, when we think about operations, we use a third-party property management company for all of our assets, and they present us technology solutions all the time. Sometimes we use them, sometimes we don't. we're typically not the guinea pig. We want people to demonstrate the value proposition before we
Of
adopt
course.
it. And then, yeah, I mean, it's everyone's a technology company, and you just have to separate the wheat from the chaff in those services that we provide. But yeah, I think that the other closing comment I would have with AI, and maybe it's not entirely applicable, but there's, I think, a joke or not a joke, but an understanding in the underwriting or modeling part of real estate is you can make the model tell you anything you want, depending on the assumptions that you put into it.
Right.
So that leads to the garbage in,
Right.
garbage out kind of thing. So I think you need to be careful with AI because you might put in something and what you get out is not what you were expecting to see, or really
Right.
isn't a solution in search of a problem.
Yeah, yeah, yeah. Have you seen it in examples where people use it to sort of, double check you, or you double check what people are telling you? It's just sort of a, kind of a second opinion sort of tool.
Yeah, I mean, certainly the large language models or other pretty simple things around, or fairly rudimentary aspects of AI that a lot of people are utilizing. Yeah, we get that. It's funny in the context of, again, being a relationship business and how much of our communication still goes through email or is electronic communication. And it's, to me at least, more often obvious than not who's someone who's sent their email utilizing a chat GPT or something else versus someone who just wrote an email.
Right. It's just a little too perfect, right? A little too crisp.
Yeah, and that's okay. I think that's
Right.
one of the ways that people are using it to be more efficient. And
Yeah.
you
Yeah.
gotta figure out what aspects of the technology are going to make you more efficient.
Yeah, I mean, I'll be perfectly honest, Tom. I think I've been using it because I do sometimes feel that, I will put it this way. I think emotions can seep into some of my communication ways. And I have found it sort of as a nice kind of way to just sort of, level set me and kind of pull me back from the ledge, if you will.
Yeah.
Sometimes I, do want to send an email that I might regret. And it's been helpful in a way that it gives me kind of an alternative way to say the exact same words. But
I'm with you, Vlad. I'm hesitant to send any emails like after 9 p.m. because I'm afraid
right,
of how I might think about it the next morning. I would
exactly.
only hope that, some of our leadership wouldn't tweet at midnight either, so that
Right, right.
they could digest what's happened and think about a better way to say it tomorrow.
100%, 100%. Let's hope this episode is heard wide and loud, right? So anyway, well, tell us. Okay, so you've got the last topic here, Tom. I'll let you kind of kick us off there.
Yeah, so sorry for just a little bit of a side, Vladimir. So do you want to chat telescope at this point?
No, you were going to bring up the office properties are trading
Correct.
at
Yeah.
levels, right?
Great.
Allowing adaptive reuse. So that one.
Okay, great. Well, yes, I think, Vladimir, when we were getting set for our podcast today, one of the topics I'd mentioned that I'd seen a recent article in the journal about office properties that are trading at extreme discounts, sometimes 90% of what they were held for pre-COVID. And that will allow, I think, a greater volume of adaptive reuse and a better utilization of some of those properties, especially in places like New York or San Francisco, where you need more apartments and less office. So
Right.
I thought it was an interesting data point and trigger. It's not a business that we're in, but certainly from the potential of delivery of more multifamily, we want to understand the order of magnitude. I still think on a national basis, the percentage of existing inventory we're talking about is going to be pretty minuscule for these reuses, but more on a city-specific basis. I think it'd be great for maybe some secondary locations outside of the New Yorks or San Franciscos, like a Kansas City or an Oklahoma City, to utilize or revitalize downtowns and have a positive outcome for structures that are functionally obsolete.
Yeah, and is your perspective, primarily sort of in a kind of office to residential conversion? Is that what you mean, or just other sort of uses? Meaning I don't know, used to be kind of a older looking office, but now it can be a modern sort of looking loft kind of looking office or something
Yeah,
like that.
I think it can be all the above, and really the
Right.
creativity is in the eye of the beholder. I think some two examples that come to mind from the article I read is that I can't remember if it's in New York or Chicago, but somebody's buying an old industrial warehouse and is going to create a hydroponic farm. So
Okay, interesting.
that's really fascinating to me, that something that was abandoned now you can make extremely productive. I think another interesting one was, taking an office building, dropping out the core to have the ability to put a pool in it, make it a hotel. I was like, wow, that's really outside the box thinking. There's an organization in San Francisco, Emerald Fund. Mark Babson's the president. Their company converted the AAA building on Market and now already like 15 years ago from an office building to multifamily. So they would love to do that again. It's just the economics are tough to make sense unless you get to this point where you can buy the existing structure for nearly free. So I think that is going to be interesting on more of a case-by-case basis. Again, I don't think you're across the country. I don't think you're probably talking more than like 1% of the existing multifamily inventory to make a dent in that. But some micro markets might absolutely see great benefit from more multifamily converting those office buildings to apartments.
Yeah, 100%. And it was certainly a big topic. I think during COVID, a lot of people were kind of asking that question. That sort of seemed to be the obvious question of like, well, we've got all these empty spaces, we're lacking in housing, why don't we just convert it into that? The obvious challenges, I think there are some physical challenges, just simply because how the building was made and how
Absolutely.
much toilets you can put in, that kind of thing. It's just sort of difficult and almost impossible. It is an interesting kind of conundrum. I am a firm believer, when you go to a city like Vancouver, Canada, not Vancouver, Washington, you do see a very mixed use downtown. You'll see an office tower next to a housing tower. It all kind of works, right? It's not that unusual even when you go to, cities in, Europe and Asia where, you don't have just like a business core. It's sort of a life core, I guess, maybe the way to put it. And so, yeah, there are still some buildings trading at tremendously, huge discounts. We just had a story this week of a building in San Francisco that traded at 85%, discount to what it was, purchased for, I think back in 2019. So those things are still happening, and I am curious how the cities help with that. And Tom, you might know more about this than I do, so I am curious what you think about it. But the cities, I think, technically do make more money in terms of revenue, taxes and that kind of thing from office building being an office building rather than residential. Is there a little bit of a push and pull from them in terms of not necessarily financially wanting those conversions to happen? Is that true? Or
Well, certainly a city is incentivized to increase its tax revenues. Property taxes are a big part of that. When office buildings were full, they were getting tremendous value from the owners who paid big numbers from that. Having said that, they are, as much as they want to, they can't repeal the laws of supply and demand. Right. So in order to rebuild that tax base from so much lost value in the office space, they are incentivized to work with real estate developers and owners to repurpose those properties and hopefully make it easier. I think the city of San Francisco and other municipalities have made strides in making these conversions easier, but land use and entitlements and zoning in major metropolitan areas are always difficult to get, and the process can be lengthy, timely. State of California specifically has appeals that can prevent progress from lots of different parties. But eventually my hope is that the cost benefit analysis leans towards property owners, these things trading at extreme discounts, and that allows people to have the basis to revitalize that. And then that increases tax revenues over time. You had mentioned San Francisco specifically. The San Francisco Center is our classic case study that is worth over $1 billion in 2019.
And for our audience who may not know what this is a huge Westfield Mall, former Westfield Mall, right on Market Street, kind of center in the downtown of the city, basically vacant at this point, bankruptcy, right? There's some folks trying to buy it and reimagine it, right? That's kind of where we're at this point in time.
Yeah, so I think in the end, the owners, I'm not quite sure where the status is, if they bid on the debt. It's a very complicated property. There's some condo interest to it, but my understanding is rough numbers. You're talking about a buy of 10 to 15 cents on the dollar. And that is an extremely new low basis. And hopefully that provides them given the cost for adaptive reuse to be economically successful. And then going back to the first question you brought up, was it then increases tax revenues for the city and the county of San Francisco.
Yeah, yeah. You probably have a good sense in terms of construction costs in general. Those have not seemed to have gone down at all since the COVID started.
Yeah.
What are, is that a factor also in kind of helping move these things along?
Certainly, it is a major factor. Again, I think that when we focus on construction costs, we're primarily focused in the multifamily space. I think that when we talk with developers and market participants, they are starting to see a little bit of pricing power on the sub-trades because they have less to do, because the development pipeline this is probably overstating it, but generally is dried up.
Yeah.
It just doesn't make sense given the cost of construction to build new. Having said that, we always somewhat jokingly chide the developer group as they're just never cooperative, and as soon as they can build, they're going to build, which is great. That's how their business model works. They're incorrigible. So we're going to see supply or new deliveries coming out of the ground sooner than folks would like to see, I think, from an existing perspective. And again, thinking about it from a multifamily space. But to bring it back to your prior question about cost reductions, I just think the increases have decreased down to 1%, 2%, 3%, and that there might be certain sub-trades that you might get pricing power. But overall, we're not seeing a huge decrease in the cost of construction. Inflation has worked its way through the material market, through the service market, and there's still pressure on those, but to a lesser extent than it was kind of 36 months ago, let's say.
Right. No, definitely. Well, good. All right. Well, Tom, we're at our sort of final portion of our conversation here. I think we call microscope telescope. This gives us an opportunity to zero in on an interesting topic, or pull the zoom lens way out and look at things from a kind of a 30,000 foot perspective. Tom, I'll let you kind of give us your first item here.
Yeah, thank you, Vlad. The topic I wanted to telescope out was on the recent legislation that was passed by the Senate for investing in build-to-rent properties. It was, I think, the market participants certainly weren't happy about it. I think if you look at statistics and the context of what they own versus prior ownership, certainly they have high concentration in submarkets, but they felt it was being overly penalized for what they provide. And I am curious to see how it plays out, whether the overall legislation passes. And I should know better since it's a topic that I selected. I'm not quite sure where it stands on the House side of it, and maybe it's been passed. But my point is that the concern has now created a stranded investment class. Stranded investments for some of the larger owners, because now they need to dispose of their assets potentially 7 years down the road or whatever the timeline is. And the anecdotes and or articles I'm seeing on this topic in the trade publications it has in essence stopped any new developments for this, which I don't think overall is good for the supply demand balance in a lot of the markets that they were active in. So that'll be interesting to see how that plays out.
Yeah, I think it's actually been very interesting. I do find it interesting that the sort of Trump administration kind of decided to go after this one. Certainly the private equity industry has been, I think, a friend of the administration for the most part. Maybe this was like one of those easy kind of ones to sort of pick as kind of, political kind of, winning points. I don't know. I mean, I'm speculating at this point. Also, if I'm not mistaken, Tom, you might know this better, but I think the BRT space or built-to-rent space is only about 2% of the entire kind of market. I don't know if that's a figure that they use to sort of make it seem like that they're not that impactful, but
yeah, I think nationwide they're a small percent, but in some markets, like for example, yes, Las Vegas, they might be 30% of the market. So yeah, it's harder for them to make the case that they don't have an impact in a market like
I
that.
agree. I totally agree with that. And we've done a couple of stories on this over the years in terms of like how much money has gone into this, and some big funds, all the sort of, firms that you would know are kind of participating in this. It is interesting. I mean, I'm for building. I am, certainly, on the side of like, hey, anything that we can do to increase the housing supply, I think is good. And I do feel, just from kind of my perspective, is that I don't think this is going to go away. I think this is perhaps maybe a kind of a temporary sort of recalibration just based on this affordability issue that we have going on right now. And it seems kind of like a low-hanging fruit to go after. That's my 2 cents, but I don't know.
Yeah, it certainly is a politically popular punching bag, to use alliteration. So I understand that side of it. And I also agree that the private equity has been largely a friend of the administration, but I would also argue the administration is largely heterodox in a lot of their policy stances. It can be all over the place, but this one seems like it was an easy political win.
100%. And yes, and I think it plays well, I think, with the base, I suppose, if that's how we can maybe put it. I wanted to kind of telescope back out, and we talked about this a little bit, but obviously, AI in the industry again. I am, very curious how people are, using some of these, tools, both in residential and the commercial side. I follow a couple of them, and there's some interesting ways how they're finding new methods to sort of integrate it into their daily work. Anything that I can say about this is watch this space, be kind of curious about it. I think try to use it. I had dinner with somebody the other night, and one of the conversations about AI that we had was about hallucination, and one of the things that I would say is that part of that hallucination story is a 2025 story, in a sense that some of the newer models have exponentially improved in as little as like the last 90 days or 180 days. And so I would say I think this is only going to get better in a sense that these tools are going to get better. What it does to the industry, I don't know if that's better or worse, but certainly I think it's one of these things that's worthwhile watching, and I'm always curious how people are using it. It does have utility, and whether it's good or bad, I think we'll have to wait and see.
Yeah, certainly, no doubt. We'll have to see how it plays out. I mean, I think about it in the context of how technology has impacted commercial real estate in the past. And certainly when we went through the internet, it took a long time for the winners and losers, or maybe not a long time, but some time for the winners and losers to shake out, for it to fully integrate into all aspects of our economy. And certainly it increased efficiency. At the same time, it also created some deep dark holes for people to dissipate. So I think in the context of AI, there's no doubt that there's going to be positive impacts, efficiency gains. We'll see how successful it's integrated in commercial real estate, given the comments I made before about the relationship business. Maybe that relationship part of it completely goes away over time. We won't know.
Yeah. And I'm super curious, some of the firms that you're using, maybe like your, property management firm, if they're integrating it in things like, contact with your, tenants, for instance, right?
Absolutely. There's AI. There's been for a decade plus now AI chat, or they didn't call them AI, they were chat bots then, where they would attempt to have an automated system answer residents' questions. So if they had difficulty getting on the payment portal to pay rent, a chat bot would walk them through that process. Or if we had a lease prospect that was looking at the website on a Sunday night at 11 p.m. when no one's on site, they would say, "Oh, I'd like to schedule an appointment." Availability, and and the chatbots would do that. So there's no doubt there's ways to integrate that technology into you being more efficient. But again, not only is multifamily on the transaction side, the financing side, historically been a relationship business, but multifamily is people to people. They're all living together in a communal, and you want on-site staff to have that human touch. It's interesting, some of the real estate investment trusts have focused on doing more technology And we have found in those certain submarkets, and we have competing property, for lack of a better term, we've eaten their lunch because we have an on-site person for person-to-person interaction versus interacting with technology all the time. So
very interesting. Very interesting.
It'll be fascinating to see how it plays out, and I have no doubt. Again, big picture, it'll improve the efficiency of our business, but how that happens, I'm not sure. Historically, whenever we've had technological advances, there's this mentality of, oh my God, it's the end of the world. It's going to remove all these jobs. And again, not saying AI is the same as past technologies, but in every instance, that new technologies has created more new jobs in industries or things that we never thought about before the technology was widely adopted. So I'm hopeful that's what AI means, as opposed to, I think, the Bernie Sanders view that it is going to be the end of humanity.
Right. Well, that is a topic for a whole new podcast, Tom, that maybe we can do in the future. Certainly.
That sounds lovely. I look forward to it.
Yeah, but for now, go humanity is all I can say. And thank you for taking the time to chat with me. This was super, super good. Really enjoyed it. And I hope our audience also found some interesting, nuggets from our conversation here. And Tom, it was great to see you. And until next time.
Absolutely. Vladimir, thank you for your time. Great to participate. Look forward to doing it again. Yes, I agree. Hope the audience gets at least one or two nuggets out of our conversation. So thank you so much.
We'll talk soon.